Good afternoon, everyone, and welcome to our special edition HUBsights webinar. My name is Karen Arthur, and I work in the marketing team here at HUB24. Before we start, I need to mention a few housekeeping items. The lines will remain muted throughout the presentation to prevent any background noise, so if you do have any questions, please use the webinar control panel to send them through to the team. We will hold a Q&A session at the end of the presentation. Today, we're joined by Brett Gillespie, who is Head of Global Macro and Portfolio Manager at Ellerston Capital. Brett will share his global market update called The World is in a Good Place, except for one massive risk. So without further ado, I'd like to hand over to Brett.
Thank you, Karen. Okay, so what I'd like to do today for everyone online is just give them an idea of where we are right now and how we work that out. So what do we look at to try and work out how the world is travelling and likely to travel over the next 6 months? And then we'll come back to the risks. And to put some context around it, in macro trading, our job or our main goal is to get the growth and inflation outlook right and then get the central bank's response right, and then how will the markets react to that. So we spend all our time trying to work out what's going on in the global economy. Now, one of our best tools, one of our favourite tools, is something we call the Financial Conditions Index, and I'm sure some of the listeners have heard of it before. There's quite a few different versions of the Financial Conditions Index around in the world, and what you try and do with them is you try and say, based on what's going on with interest rates, with the currency, with equity markets, even housing markets, with corporate lending rates, based on all those factors, how would you expect all those factors to combine together and influence growth? And that measure there, the 12-month change in our Financial Conditions Index, has a nice lead to where growth is tracking. Now, we've used the Atlanta Fed forecast of quarterly growth to give a guide of real-time growth because we wanted to show that our Financial Conditions Index for the US is projecting quite a nice recovery now back towards 3% growth. So if that was all we're looking at, and usually it is all we're looking at because we've got to have some sort of exogenous shock to derail that sort of view, we'd be saying, and we were saying this indeed back in April, that US growth looks like it's going to go back towards trend over the next 9 months. And the main reason for that is because US 10-year yields have fallen so much, they're providing a really nice stimulus to the US economy now. And if you recall, when we went down to that trough back in January, December, that was when the equity markets were falling 20% in the US. So that tightens the financial conditions. And as we've bounced out of that, supported by the Fed, they've actually managed to engineer quite a good loosening of financial conditions, leading towards something like 3% growth. So that's why I say the world does revolve around the US. The US is in a pretty good place right now. We've had enough easing in financial conditions to underscore growth over the remainder of this year. Similarly, if we look at Australia, the relationship doesn't fit quite as tightly because we do get quite a bit of movement around in the commodity cycle, but it's still a pretty reasonable fit. And with the rate cuts we've had here and with equity markets on their high, it augurs quite well for growth moving back towards 2.5–3% in Australia over the next 9 months. So again, we've had the rate cut here. We've had that feed through into the lower lending rates, and that will boost the economy. We've also had a rally in the equity market, also helped by the coalition victory, which has led to that little pop at the end there from 2.5 towards 275 for growth. So again, the outlook for Australian growth, when we put all our factors together, says that we should have a mildly accelerating growth path, very similar to what the RBA is talking about. You can even see in Australia, we've already started to see a little bit of a bounce in the business surveys. So the first one here is the AIG survey of purchasing managers, and the second one is the NAB business survey for confidence. The NAB survey was half before the election, half after, so it's just got a little bit of the post-election bounce. That said, the consumer confidence number today in Australia was actually quite weak because people felt like if the RBA is cutting rates, there must be something wrong. And that was actually the questions before the rate cut polled higher for confidence than the questions after. But you would expect to see a little bit of a fillip to confidence in Australia because whether you were going for coalition or Labor, for business and for the household sector, it does improve confidence. We've already seen a response both into and out of the election in the housing market. So what we've been watching in Australia and we've been talking about for quite some time is house prices have been falling. So The orange line is the 1 month change in house prices. It's been below zero since the start of last year. So we've been falling every month pretty much since the start of last year. As we come into last month, we were still falling at a rate of 0.3 or 0.4% a month, but much less than we were at the turn of the year. And the auction clearance rates suggest that the bottom in prices are going to start to rise imminently if we sustain these sorts of auction clearance rates. And so our endogenous picture, if you like, if we were looking at Australia and ignoring the rest of the world, we'd be saying the combination of rate cuts, the lift in confidence out of the election would suggest we've got a bottom coming into the housing market in the next few months, and that the economy is going to follow the sort of trajectory that the Reserve Bank's talking about. We think they've got to make a little bit more room for unemployment, but there's a bit of a hangover in the construction sector that's going to lead to a rise in unemployment for the next few months, but then it should be okay. One thing I don't think people pay enough attention to is how beneficial rate cuts are. So when it comes to housing, you hear a lot of people talk about debt to income. And having nearly 200% debt to income in Australia, we stand out as one of the top 3 or 4 countries in the world for household debt. And that alarms a lot of people. But the reality is that the thing that really matters to the household is the servicing of that debt. And so this chart here shows the 40-year history of how much income is going towards servicing household debt. Now, the shaded area is with 2 rate cuts. So we've had one, and we expect another in August. And you can see with 2 rate cuts, I'm just going to put a little cursor on there for you, we're literally going back to the levels of the mid-90s in terms of debt servicing. So it's never been more affordable for people to be buying a house. And that's why you'd have some confidence that the cycle's going to turn here. And if you think about where debt servicing got to just prior to the financial crisis at 14% of income, and we're now tracking at 5.5%, it's very affordable. And we've had a nice adjustment in prices as well, so we don't see housing as overvalued relative to income. Same goes for the equity market. So when we keep this sort of endogenous view on, if you like, and we try and say, how do we see the equity market? I've popped up here what looks like a very confusing chart. But what we're doing here, where you don't want to be is the top right quadrant. Because if you're in the top right quadrant, that means valuations are very expensive, and that means there's been a lot of growth and momentum in the market, and it's a bit over its skis. So you would expect some sort of pullback. And so we find where we've put that cross to the top right corner, whenever we're in that part of the valuation momentum growth trade-off, we're expecting a pullback in the equity market. So the red dot at the moment is sort of middle of the range on valuation, slightly expensive, and cheap in terms of its growth momentum quality trade-off. And so normally this would be a time to stay invested in the Australian market, particularly with the catalyst that we're talking about, which is the rate cuts coming through and a coalition victory. So that's the reason for the heading of the pack, which is to say things are looking okay, if not reasonably fine. The problem is tariffs. Now, we've had tariffs on and off from Trump since March last year. And the result so far has been a bit like the boy who cried wolf. It caused a lot of panic in March last year. It caused some panic around September, October last year. But in the end, if you got panicked out of your equity holdings because you were worried about tariffs, it's been a mistake. I've put this chart up here just to show the history of tariffs, because we are really talking about Trump going back towards some of the extreme tariffs that we saw under Smoot-Hawley. So he's talking about going to a 25% broad tariff across all Chinese imports if the Chinese don't comply on this tariff arrangement. The blue line is total imports. So Smoot-Hawley was only applied to a third to 40% of the imports in the US, which is very aggressively on that pool, but the average tariff only got to 20%. So you could see a pickup in tariffs, not quite as big as that, but it is a reason. We do know that tariffs hurt growth. What we don't know is how much, and this is where you get an awful lot of smoke and debate about what that's going to mean. And so for the optimists out there, they'll say that tariffs aren't going to have that big an impact. They'll say that tariffs are like a tax, We're talking about taxing the US economy, or we're talking about taxing Chinese imports by, if we do the extra 300 billion at 25%, that's $75 billion. That's about 0.3 or 0.4% of US GDP. So if you were to apply a tax of 0.3 or 0.4%, which they do quite frequently when they increase taxes, it's not going to derail the economy. And in fact, people will argue for even less pass-through, because they'll say some of that cost will be borne by the Chinese exporters, where they'll just wear that by lowering their prices. So you get most economists painting a fairly benign picture of tariffs. This model that I've got up here it's been done by Bloomberg using the Fed's economic model to work out the impact of tariffs. And this has a little bit of financial conditions in it, because it actually allows for equities falling 10% if tariffs get applied, and the feedback that would have onto growth. And you can see for the US in the middle there, over the course of the next 2 years, its peak impact is about 0.4% for what's currently on. Now, if they were to take the tariffs to all goods, the number's almost double. It goes to, I've written on the bottom there, it goes to 0.7 for the US, 0.9 for China. So they're starting to become material numbers, but it does mean we're still only talking about US growth going from, say, 2.75 down to 2%. It's not a recession. So that's where you get the benign view on tariffs. The problem with that is you're not making any allowance for how tariffs actually affect the corporations. You're just treating it as if it's a tax that's gone on, that's its only effect. In reality, people are moving their business out of China. They're stopping CapEx because they're not sure which country to invest in. And so what we saw, I haven't got the chart here, but what we saw last episode, so when we did the 10% up to 25% tariff on the first 200 billion of Chinese goods, we saw a much bigger impact on what was going on with trade in Asia. And so some economists, like Seth Carpenter at UBS, have taken that impact that occurred in Q4 from the first round of tariffs and modelled and extrapolated off that to say, if tariffs were to be applied to the extra 300 billion, we're going to see about double the size of the impact on that chart. God forbid you put the tariffs onto Mexico, which is now backed off on, but if you put the tariffs onto Mexico, you could see a 2% hit to US growth. So it's a very big deal when you start taking account of the fact that corporates are going to start redirecting their supply lines, and you're also not factoring the retaliation from China, which can go tit for tat on tariffs, but the main way they retaliate is we've seen them talk about not exporting rare earths to the US. Now, 90% of refining of rare earths is done in China. They're responsible for 80% of the supply, and that goes into everything from mobile phones to health equipment to electric cars, and in particular to defence missiles and so forth. So, China can get quite nasty on this tariff side as well. So we think if it escalates coming into the G20 and the next tariff meeting, it's going to be a lot worse for the market than what the economists are saying, and we're going to see something that could rival what we saw in Q4 last year, and that's expecting that it stops at the 300 billion. There's other ways that this can evolve. So the market has got very spooked about this, but it's mostly in the rate market. People are looking at the equity market going, well, the equity market doesn't seem to be concerned. Now, the rate market is. So this chart here shows how much is expected in rate cuts from the Fed by the end of this year. So as we came into the 1st of May, where I've drawn that line, which is the 3rd of May, the weekend that Trump announced that he was going to reverse the tariffs or have a tariff war with China, the market was expecting about 20 points of rate cuts from the Fed this year. And it has been consistently climbing from the beginning of May to the end of May towards about 50 points. And then he announced at the end of May he was going to put a tariff on Mexico, and it jumped to 75. So basically, the Fed is expected to ride to the rescue if tariffs are put in place and do up to 75 points of rate cuts. Now, the interesting thing is it actually hasn't come back from 75 when Trump has announced he's not going to do the tariffs. And the reason for that is because we had a very weak employment number in the US last Friday, so it kind of offset that benefit. So the market's currently expecting the Fed to ride to the rescue and provide support to the equity market. This shows you how extreme market expectations are. So You've heard people talk about an inverted yield curve and how that flags a recession. I'm not a big fan of the 2s10s curve because the 10-year part of the curve has been distorted by QE, and so it's not useful to compare it back to past episodes when there wasn't QE. But the next 2 years of expectations from the Fed, which is the green line, and it's actually the measure that the Fed likes to use, that's not distorted by QE. And you can see at the moment, the green line is indicating -1, which is about 1% or 100 basis points of cuts is expected in the next 2 years from the Fed. Now, you've only had that twice before, in the financial crisis and in the dot-com bust recession of 2001. So the forecast from the rates market is we're clearly going to have a recession. You look at the equity market and you go, that seems a bit strange. 10-year bonds have rallied 45 basis points since the sell-off last year, or the disaster at the end of Q4. Equities are back near their highs. These guys, they're not on the same page. Well, what's going on with the equity market is a massive rotation. So there's obviously stocks, defensive stocks, that benefit from lower treasury yields. And if you had a basket of stocks that benefit from lower yields, be they defensive, infrastructure, and so forth, they've actually been rallying or outperforming over the last 2 months. If you're exposed to stocks that require stronger growth, they've been dramatically underperforming, and they're back to where they were, near where they were in December. And the divergence has been particularly stark, as you can see, in the last 6 weeks since the Trump flare-up on tariffs. So the equity market looks to be treading water, but it's doing an awful lot of running under the surface and restructuring. And this will need to reverse if the tariffs don't go ahead. But if they do go ahead, you will see more of this. But I think the blue line will overwhelm the red line, and we'll see the overall equity market going down. This was the chart I should have put a little bit earlier in the presentation. So the Asia exports ex-Japan, that dip that we did in the start of this year from running at about 5% growth down to -5, that was the impact of the tariffs of the first round. So when I mentioned the economist who says you could get a 2% impact on a broader tariff war, it's because you're getting this impact on Asian exports as the supply chains get moved around. And that's why we think the economists are missing the picture here. So I've mentioned I've put some numbers out there already for you on the tariffs. This slide here will just summarise it for you. But what I think the markets will do is they will panic first, and then they'll ask questions later about the growth impact. So right now, if you did a survey of market participants and said how likely is it that the 300 billion tariffs are going to be applied to the last 300 billion, the answer will be just over 50%. So if it does get applied, the market's still got quite a bit of a reaction to do. And then if you start to see Asian trade plummet like it did last time, you'll start to see the global impact estimates jump again. And that's where we'll start getting into a bit of a concerning cycle here. And that probably brings Trump back to the table. A point I would like to make about Trump, though, is it's not actually just the equity market that he cares about. He cares about the polls. And the real reason, and this is when we talk to our consultants that we subscribe to in Washington and in China to try and tell us what's going on, the real reason that Trump on May 3rd turned around and said the talks are off wasn't because the Chinese were negotiating too hard. It was because the latest polls showed Joe Biden on a head-to-head election was going to beat him by about 8 to 9 points. Biden was indicating a significant victory at the next Democrat election. And that was the real catalyst. So what you do need to watch is Trump's looking at the polls, and he's looking at how much reaction he gets from the polls. And that's why he went hard on China, and that's why he also turned on Mexico and immigration. So people were kind of trying to think, why is he doing this thing with Mexico? It's because of the polls, and he's got his eyes on the next election. So this is what we have to watch. So he won't mind a little bit of carnage in the equity markets if it's helping him out in the polls. The other thing you need to understand here, and why we think the tariff risk is so large, is the Chinese are completely baffled, and they've lost complete confidence in negotiating with Trump. The negotiations that were going on were proceeding in a normal way, where each team would send a draft back to each other and try and change things. And the Chinese did send back a draft where they tried to change 45 pages out of the 150, but they said it was no different to what had been going on through the whole process. When Trump just pulled the trigger and said, no, I'm out, they no longer trust him. And we've now got Trump trying to line up the meeting at the G20, and interestingly, President Xi has not accepted the meeting yet. And Trump said, if you don't accept the meeting, I'm just going to put the tariffs on immediately, which isn't a very good way for President Xi to save face going to a meeting. President Xi also is no longer letting any of his team negotiate with the US. They're just stepping back, and they're actually preparing for the worst. So they're turning their focus now to engaging more with Europe, engaging more with their One Belt, One Road partners, and accepting they're going to have to wear a battle with Trump and maybe hope for Biden. So we're not particularly optimistic on a resolution on tariffs in July, and so we're advising and we're positioning in our portfolio for this escalation to occur in July. We do that by being short the renminbi against the US dollar in our currency plays. It would probably mean the Aussie dollar goes down a bit, but that being said, it's not the cleanest way to express it because there's supply factors affecting the commodities in Australia and supporting the currency. But it will probably mean that interest rates in Australia, if the tariff war does escalate, instead of interest rates in Australia bottoming after one more rate cut at 1%, then they would likely go down to 75 or even 50 basis points if the tariff war got bad enough. So I've gone a bit ahead of myself there. So we're going to be very defensive into July, but at the same time, if for some reason Trump and Xi do get together at the G20 on the sideline and they do work out an agreement and they walk away and say everything's fine, this is all going to pivot really quickly. And the first trade will be to be short US rates or look for higher yields in the US. The equity market will love it, but you will have to get that rotation under the hood. So back into growth stocks and out of stocks that perform with low interest rates. So it won't be as explosive on equities as what it will be on bonds, where bonds will do quite a sharp sell-off. And so we're sort of advising people that they need to be ready to be very nimble in July. They need to be defensive going into July, and then be ready to be very nimble if Trump somehow pulls off an agreement, which at this stage we're not expecting. But as everyone I think would agree, you can never predict Trump. I've got the trades there for you on the last page. I think that was the last page, and we'll come to questions.
Great, thank you very much. So just a reminder, everybody, if you do have a question that you'd like to send through, please use your webinar control panel and send it through to the team. So we've got a couple of questions that have come through. This is just around rate cuts. When do you next think the RBA will cut rates, and how many more times do you think they'll do it? So the market expectation right now is about a 60% chance of a cut in July. So that would be a back-to-back rate cut. I think RBA Governor Lowe has been reluctant to cut the whole time. They don't like getting rates down this low, but the logic of their framework, if you like, means that they have to cut to get back to target inflation. But doing back-to-back would look too quick and would look a little bit panicked. So we think they'll stretch it out a little bit, probably August. But we also think, and they've effectively told us, they do need to do, on their calculations, they do need to do another rate cut before the end of the year, just to achieve their forecast. So the next one's pretty much a lock. It's just a question of whether it's August or a month or two later. And then the real debate is, do they go lower? They would expect hope to not have to go lower. Their forecast, if you go back to the endogenous outlook that I had, would suggest they don't need to go lower. But again, if the tariff war escalates, they will have to go lower. Great, thank you. And another question, probably good for first home buyers. Are you concerned about the Australian household debt to disposable income? Surely the housing market has further to fall. So we touched on that. We touched on that earlier. I think a good way to think about debt is people don't really think too much about how much they've got borrowed. They think about how they service it. So that's why I put up the servicing chart. So yes, Australia's debt to income is amongst the top 4 or 5 in the world. But our interest rates are very low, and it also doesn't take account of the fact that we have negative gearing. And it's only us and New Zealand, I believe, in the whole world that allows negative gearing on investment property. So that naturally makes our debt higher than it would be when you compare to other countries. So I don't find debt to income a particularly useful or alarming measure. Debt servicing is sort of the be-all and end-all when it comes to housing. And now what we've seen over the last 18 months to 2 years is
we've effectively had rate hikes because of the macro-prudential tightening that's gone on. So the fall we've seen in house prices has been a combination of a perfect storm of big tightening in macro-pru, a big increase in supply of housing, and also the Chinese buyer pulling out of the Australian market because of capital controls out of China. And so you've had a bit of a perfect storm that's led to this decline, but we are now coming into a period where it's just getting quite a lot more affordable, and we don't see property values as overvalued. We see them as around fair. So bottom line is, if we don't have a tariff war, we'd expect a bottom in house prices, sort of within the next few months, and then back to sort of 3-4% growth a year.
Okay, great, thank you. We've had another question. This is around investment strategies. So how long do you have to be defensive for?
If the tariffs escalate, you're going to want to stay defensive at least for 6 months, I would say. I mean, we've seen an escalation before, which when the market starts to panic, it will take 3 to 4 months to sort of sort itself out. But what we're looking at is you've got to see the end of the escalation. So the way the market prices, and we sort of saw this last month with China, was when Trump said, I'm going to put the extra 300 billion of tariffs on if they don't agree to this agreement, the market said, oh, brinkmanship. So that'll change in time. As time passes, the market gets more and more concerned that it's not going to change. So if Trump comes out the week after the G20 meeting and says, we're going ahead with the tariff, the market's initial reaction will say, okay, we have to price some risk for that or some downside for that. But let's assume that the Chinese aren't going to like it very much. And in the space of a month or 2 months, they're going to work it out. And as that doesn't happen, the market will just continue to price in a worse and worse economic outlook. So it won't, there's this brinkmanship that sort of keeps the market somewhat confident. The Fed put is there now. The Fed, will come in and cut rates to support the market. So it'll be more of a choppy down move rather than a free fall because the market will always retain that little bit of hope.
Great, thank you. Another question or a two-part question has come in. Are you concerned about a stagnation scenario in 2020 if the trade war escalates materially, and how does the Fed react in that regime?
It's a very good question because it will be inflationary. So our estimate, if the tariffs went on across the board for Chinese imports, is that US inflation will rise by an extra 0.4 to 0.5%, and you're getting a hit to growth. So as you define, you've got stagnation. The Fed will probably respond to the growth story. So they will cut even more aggressively than what's currently priced into the market. So we've got 100 points priced in over the next 2 years. You'll probably end up getting 100 to 150 points in the space of a year from the Fed, trying to underpin that growth story. And the real question becomes, how disruptive is it for supply chains and investment? Does it turn into a recession, or does it turn into a tax stroke, tariff impact that shaves 1% off growth? Because you can obviously compensate for 1% off growth by cutting interest rates. But if it's 2% off growth, you're flirting with a recession and tipping into that. And that's the debate that the market will have, and it'll price some risk of recession. So if it turns out just to be stagnation, I think you'll find the inflation pulse will pass through from the tariffs and that within a year. And then you'll also have a reaction from growth to the rate cuts. And so it would only be 1 year, I think, 1 year or so of stagnation before things normalise a bit.
Okay. Great, thank you. It looks like we've come to the end of the questions, so I might wrap up. Thank you again to Brett and to Ellerston Capital for presenting, and to everybody who dialed in. We will share a recording of the webinar after the session, and we'll also post it on our website, so keep a lookout for that. If you'd like to get in contact with Ellerston Capital, speak with your BDM or email marketing@hub24.com.au, and we'll put you in touch with one of the team. Thank you again and have a lovely day.